Welcome, everyone, to the Ultimate Advisors Resource Podcast. Today, we've got an interesting topic. I don't know how much questions I get about this, but I think it's important to talk about it at the bare minimum. And that's if doing an overfunded IUL or doing life insurance as a retirement plan in general, you're going to come across some objections. And I think there's, in my opinion, really maybe like 3 common objections, and they're all sort of centered around the same thing. And the first one the first one is number 1, "Hey, I've heard buying term and investing the difference is better than buying," and they'll almost always say whole life. So that's the first one. The second objection is somewhat similar, and it's like around or along the lines of, I've heard IUL is a bad deal, and so that's kind of similar to that. And then the final one is like, what if I need the money? What if I need access to the money, and how does that work? And I'll throw in a fourth bonus one, and it's more of obscure. Like, I don't know how somebody would know this other than they were coached by some whole life person. And that is, I've heard the COIs get more expensive the expenses get higher every year in an IUL. So starting from like top to bottom, how do you overcome these objections? Well, the first one is an interesting objection, and that is, shouldn't I buy term and invest the difference? And the answer is maybe. It really comes down to your tax rate. If your tax rate is 0, then you're probably better off buying term. Well, I, I use this lightly. There's no advantage investment wise to do the insurance. If your tax rate's 0, if your tax rate is anything higher than 0, there's probably some advantage to using insurance for accumulation, not in lieu of, but maybe in addition to, or as an additive to doing some sort of taxable investment. And I'll show you why I would get to that point. I've got actually a presentation. I'll share my screen. But this is a very common one, and usually it's rooted in a couple of things. Number 1, they don't really want to put the money in. They maybe don't have the money. That could be it. So it could be a budget issue. So you've got to make sure you do a really good job in understanding what their budget is and how much they can set aside on a regular basis and getting it to a comfortable level. I've only seen these types of products fail. And what I mean is overfunded IULs and life insurance retirement plans. I've only really seen these things fail when the client does not put in what was originally planned. So number 1, buy term, invest the difference. I should do that instead of this overfunded IUL or this quote unquote whole life policy. Most of the time they've gotten that advice from their dad or from the radio or from some TV pundit. And my first response to if they heard it from the TV pundit is, what is that TV pundit's or the radio guy, Dave Ramsey, whomever, Susie Orman, whatever, what is their motivation? Like, who are they talking to? Number 1, Dave Ramsey especially is talking to most of America who is in debt. So my first question is, hey, Joe, you're listening to Dave Ramsey and you think he gives really good advice. That's fantastic. But are you his typical audience member? I mean, the typical person that he talks to, especially if you listen to his call-in show, is somebody who's in massive credit card debt. Is that you, Joe? If that is you, then you should buy term. And you should get a lot of coverage, because if something happens to you and you die, your wife is going to need money to pay off that debt. And most of the time that's not the person that you're talking to. If it is, you need to find some better clients. But that's not the person you're probably talking to. The second thing that I would almost always say is, okay, what advice do you think, like Dave Ramsey his goal is to get more people to listen to his radio show, more people to buy his stuff, more people to go into his lead program, which he, by the way, is selling leads to financial advisors. So what's his goal? His goal is to get listeners. What is the most palatable advice that people want to hear from somebody as a quote unquote expert? If I'm asking an expert about something and I say, and he's giving the advice of, you should spend the least amount of money on life insurance as possible. That sounds fantastic. That's exactly the advice that me, Mr. Layperson, wants to hear, that I should spend as little as humanly possible on this commodity, this thing that I don't even want to think about, which is life insurance. So the most palatable advice is spend as little as possible. Secondarily, insurance products, specifically cash value insurance products, are very complicated. How in the world is Dave Ramsey going to explain how a LIRP works in a 15-minute segment on the radio? That's going to be a big challenge. So just think about his motivations, or any radio talk show person. What are their motivations? And what is the format? The format is lending itself to this being a big challenge, and that being presenting and talking about a LIRP, when it's way easier for me to say just buy term and invest the difference, because that's what most people want to hear. He's essentially saying spend as little as possible. Don't spend spend bare minimum, buy enough coverage for your family, and go along your way. Now, I do actually agree with buying term. In fact, I think it's a smart thing to do, because there's no freaking way that me in my situation where I've got 3 little kids, I've got a wife that stays at home with the kids and takes care of them. There's no way that I can buy enough permanent coverage to satisfy the death benefit need should I die and replace my income. So I think buying term is not a bad thing, but I think saying you should only buy a term is probably not a good advice. So back to my original point, buy term, invest the difference. There's a material problem with that advice from the radio people. Now, the follow up with this is, do you have a presentation that proves the cost of insurance for you is lower than the taxes that they would have otherwise paid? Now, we always, for any life insurance retirement sale that we put together, we always utilize this presentation. Now, I'm going to share my screen. I'm going to share a sample life insurance retirement plan. Hopefully everybody can see this all right. But what we do is we put together this life insurance retirement plan. Now, the point of this presentation is not to say that the alternatives are bad. It's not to say that life insurance is better. This is 100% to say the taxes that you would otherwise pay are more than the cost of insurance in this insurance product. So let me run through this really quick. If you're an advisor out there and you've got your own brand, your own company name, whatever, if you're working with us, we actually changed the logo and the color schemes to match like match your firm. We're also going to take this stock photo guy, and we're going to change that to match the demographics of the person that you're working with: age, race, gender, whatever. So if you happen to be in, I don't know, the Hispanic market, we would change that to match the demographic that you're dealing with. So anyways, this presentation is fantastic. By the way, we also have another one that's a buy term and invest the difference one. It actually is even better than this, but I like this LIRP one better, frankly, but different flavors. So, anyways, this presentation goes through and it talks about, when you're planning to retirement, there's a couple of different ways to save. So, number one, you could save in a taxable investment account. Put money in, it grows. You pay taxes when as it grows, and that's that basically. Second thing is a tax deferred accumulation vehicle, which is an annuity. Annuities, you pay taxes only when you take it out and only on the gains. Qualified plan, 401k, IRA, etc. You get a deduction on the front end. You pay taxes on everything on the back end. But Mr. Client, I don't know if you know this. You can actually put money into a life insurance policy, a cash value life insurance policy. It's going to grow tax deferred and you can actually take it out tax free. I think most of my audience probably knows that, but that's how I would say it to a client. Anyways, the type of policy that we're talking about is an index policy. Benefit of that is if the market goes down, you got a floor of zero. Cap's going to be somewhere around 10, 11, 12% based on the carrier. And it'll be tied to the stock market. And then we go into this really nice conversation right here. I'm going to zoom in on this a little bit just so everybody can see. I like this. I always go over this. You should always go over this when you're presenting this. And it's only thing that's going to get you deductions is the qualified plan. However, income tax deferred growth of values, the insurance has that, the annuities have that, the qualified plan has that. No contribution limits. Insurance has it, etc. So I go through each one of these and say, look, what I'm showing you is the life insurance, but some of these other strategies have this same benefits. No 10% penalty for early distributions, no required minimum distributions. Distributions aren't taxable as income. We could have a disability completion rider in life insurance, favorable estate tax treatment if we're structuring it properly, income tax-free death benefit. And finally, the life insurance has creditor protection. And again, I'm not saying any of these other things are bad. I'm just showing you the benefits. Finally, and then I'll get into my underlying point or why this is important, but I think this is important. It's a joke, but this is just as important. Currently, highest marginal tax rate is 37%. Did you know it's been as high as 70 or even 90% in the past? Now, given all of what's going on, the debt, et cetera, the spending in the government, where do you think taxes will be in the future? And most people say, I think taxes will be higher. If you don't think taxes will be higher, email me and explain why. My email, I'll put it in the comments, but email me and explain why, because I have been saying this for a little while, to be fair, and they are higher. I got in the business about 2010. Taxes are slightly higher than they were then. It hasn't gone up as much as I would have thought, but there's no way taxes go down. Let's put it that way. So, anyways, this is just a plan overview, and we're doing 25,000 for 20 years into this plan. But what we're doing is we're comparing that to a taxable investment account, an annuity, and a qualified plan. Okay, we're going to assume the same rate of return. We're putting the same amount of money into it, and this is how you prove or show a client that the taxes you're going to pay in the taxable investment are going to be greater than the actual cost of insurance in the life insurance. If I put the same amount of money into each of these for 20 years and then I take income from age 65 to 100, life insurance will give me 91,000, taxable investments will give me 46,000, annuity 41,000, and the qualified plan, y'all, is going to get me the closest. And what I did was I grossed the qualified plan up to the pre-tax contribution. So we put in 38,462 into the qualified plan, and we assume the same taxes on the back end as the front end. Now, if I assume higher taxes on the back end, this gets slaughtered. I don't want to make it one-sided. I just want to show you how this works. So the whole point of this is to simply demonstrate that in spite of the expenses for cost of insurance and all that other BS, the insurance can actually provide higher income. And if you actually look at the cash value in your at age 64, look at the taxable investment. eight 825,000, well, 826,000, let's just say that, versus a million in surrender value in the life insurance. Huge difference. Huge difference. Which would you rather have? Again, I'm not saying that investing in the stock market outside of an IUL is bad. I'm just saying if I assume the same rate of return, um, and the same floor, etc. I'm sorry, same rate of return, same contributions, same timeline, insurance has more money. What would you prefer? Now, you might get the objection, and that is, well, my investment account's going to do 8%, not 6.7. Fine, fine. In order to match the life insurance and income, you see what I highlighted down there? Your taxable investment account has to earn 10.5% to match the life insurance. And let's be real, if your investment account does 10.5, because it's an index policy that we're talking about, that index policy is going to earn more than 6.7. So, but let's give them the benefit of the doubt. Your taxable account's going to have to earn 4% more than the life insurance to overcome it. That's the difference, 4%. So that's the point. That covers that objection of buy term and invest the difference. I love this presentation. If you want the presentation, you should email us. We'd be happy to work with you on this. This is something proprietary to our firm, and I think we do a great job on it. Now, two other objections built into here. That is the access. The access. Most people look at this and they're like, year one, I put in 6,000. Oh, and by the way, you might get, I'll talk about that in a minute. You might get somebody who's worried about the initial surrender value. Now, you could do a high early cash value rider, and that would help. It's not going to give them 100%. The way to talk about the surrender values in the beginning is all about liquidity and access. So I would point to year 5 here and say, you know what? That's a great point. What if you do need money? What if you find an investment you want to do? What if you do whatever? Fantastic. Did you know you can have access to almost 100% of your surrender value at any point? And in fact, if you're in year 5 of this and you borrow out 100,000, insurance company is going to charge you roughly 5%, which is $5,000. And that 100,000 is still going to stay in the index and earn whatever the index does. So let's just say the index does 7%. Well, on the 100,000, you earned 7,000. They charged you 5,000. So you netted 2,000 off the money that you went and took somewhere else, either for an investment or whatever. So you're actually able to leverage your money and earn money off money that you've distributed. So that makes this strategy even more powerful and more attractive over time. I will also bring up, if somebody was really in on the expenses, I will bring up that these policies are designed to be front loaded. But if you look at an internal rate of return report after 15 years, the IRR on this is going to be somewhere around 1% less than the gross rate of return that we ran the illustration at. So in other words, the expense annualized over a 15-year period is only 1% per year of the cash value. It's really very small in the grand scheme of things. And again, that 1% is going to be way less than the tax you would have otherwise paid. So I like to bring that up as well as an objection that some people have. So I'll stop sharing this and I'll go back in here. I think I stopped sharing. The final objection that I will sometimes get is, oh man, I don't think I can commit to 25,000 a year. I will ask them, well, why? Like, what makes you say that? I try to avoid saying why because it's very accusatory. I will try to say what makes you feel that way or what makes you say that. Um, I don't know who taught me that. I think it was one of my first GAs when I first got in the business told me to always question somebody with saying what makes you feel that way or what makes you say that, something like that, then rather than why. Why do you feel that way? Because it's like off putting, but it's a total side note. Other objection is what if I can't pay that much? The 25,000, that seems like a lot. I will bring that premium down immediately. Because what I want to make clear to them is that, look, this has got to fit in your budget. And if you're worried about not making the $25,000 payment every year, don't do this. Do a lower amount because the worst thing that can happen, again, the only reason that these fail is if somebody does not contribute the maximum into them. So number one, always go down. Um, but I will also tell them, look, if they're younger, like 30, 40, this is 100% true. Look, if you can give me 3 payments of, of, um, of the maximum, the 25,000, this is going to work. The cash values will grow over time. You'll be all right. If you can give me 5 payments of 25,000, that's fantastic. That'll do pretty well. Ideal is at least 10. If you can get 10 payments of 25,000 into this, and I'm using 25,000 because that was the illustration, but whatever the max premium was based on your illustration, if you can get the max in, great. And then they might ask, well, what if something happens? Can I change the premiums? Of course. Again, if we go 1 year, you put in 25,000 and then you've got to reduce it, that's okay. Again, I want 3 payments. So you got to get 75 into this over the next 3 to 5 years. So if you have to skip a year, you can always make up for that later. If you have to skip 2 years, that's okay. But let's really try to make it up in the 3rd or 4th year. So I emphasize that it's flexible, but there's a certain minimum level of funding that you're going to want to do, or else you're going to, for lack of a better word, screw yourself. You're going to shoot yourself in the foot. So I would almost always bring that up. And if you have any questions on how to position that, let us know. The final thing is, I've heard IUL is a ripoff. I just saw Kyle Busch telling everybody that they shouldn't buy IUL. Perfect. Great opportunity to talk about how people are getting ripped off in IULs. The Kyle Busch scenario, there's this 401k conversion scenario recently. Um, both of those cases, they were using Pac Life's policy. Not that Pac Life's bad or anything. They're using a Pac Life policy. And the thing that they did was they had too much death benefit. Now, I wouldn't tell the client this, but just so you know, you can even tell them, look, the agent compensation is based directly to the amount of death benefit. And in both of those cases, and furthermore, the death benefit is directly correlated with the expense inside the policy. So in both of those cases, the agent maximized out their compensation. Now, the way that I'm presenting this to you, or the way that I'm telling you to do it, I've minimized the death benefit, meaning I've put the death benefit down as low as possible, which has reduced the expenses as much as possible. So, in other words, yeah, you're right. People have gotten ripped off. And in fact, I can tell you exactly how they got ripped off because they had too much death benefit. What we've done is actually lowered that death benefit down as much as possible because there's a certain guideline to how much death benefit you have to have per the amount of premiums or contributions you're putting into this policy. So we've minimized that death benefit to where really above that's 25,000 I'm showing you can't really put much more than that, or else it'll create a modified endowment contract. Modified endowment contract removes the tax-free loans and some of the other benefits are related to the cash value. By the way, this is a misnomer. Some people think it somehow impacts the death benefit. It does not impact the taxability of the death benefit. Death benefit is still tax-free if it's a MAC. Total side note. Any rate, yeah, people have gotten ripped off, and how they got ripped off was agent maximize comp. I'm looking out for your best interest. I'm minimizing the amount of commissions based on the death benefit by squashing that down as much as possible. It's as simple as that. If you want access to our life insurance retirement plan, reach out to us. We'll tell you how you can get set up with us and how you can get access to it. We help coach our advisors on overcoming these objections. So if you have a case you want to work through with us, reach out to me, schedule a time, shoot me an email, um, whatever, get in touch with us. We'll talk to you. We'll help you close that case. Any other questions? Like I said, we'll link the contact information in the download or in the description and look forward to working with you. Thanks, everybody.